Well, it's lovely to see so many people here today. I'm glad that we got the bigger room. If anyone remembers last year's event when we were all squeezed in like this, we tried to deal with the sound, and Amanda's going to try and fix that further here. So it's really good to see everyone here today. I'm Josh Curtis. I'm one of the partners at A4G. It's my job in the firm to analyse the budget on budget day and send that out to all of our clients and potential clients. And then today I just want to give you a bit more analysis and discussion about what we've seen from the budget. That sounds better. I can actually hear myself coming from the speaker now. I'm also going to be joined by my colleague Joe. He's going to talk to us a bit about pricing and actually business performance underlying it, so not just relying on defending against the tax rates that we currently face. I'm also going to be joined by Patrick, who's joining us from the Bank of England, and I'm sure that's what everyone wants to hear about, what the Bank of England are foreseeing for the rest of this year. And Tim is very kindly joining us to tell us what the FSB make of the budget as well. So a little bit about A4G, anyone who doesn't know us. We're a firm of accountants based in West Kingsdown. And are you turning the air conditioners on to make it more comfortable?
All the lights.
Is that better to see the screen? Yeah. Well, that creates a nice bit of atmosphere. So our mission statement is to be the best all-round advisors to own and manage business. We're not a traditional accountancy practice. What we try and do is help our clients grow their businesses. A4G stands for Accountants for Growth because that's what we want to be for our clients. And basically I summarise it to say that if you've got the guts to be in business, we've got the knowledge to help you. And that's what we try and do. And hopefully today we can demonstrate a bit of that. We've been around for 30 years next year, so we've been around a long time and we're not going anywhere. So we're a pretty solid firm. I've already run through what we're going to talk about today. So a quick show of hands. Who thinks that the budget gave them something beneficial to take away? Maybe one. Yes. Actually, yes. Also one. That's really interesting. So I did a demonstration run of this presentation and all hands went up, but that was because it was to all the employees in the firm. So they clearly had a benefit. So that's interesting. It's good to know who we're talking to. So I want to talk about what the budget means to own and manage businesses, but I'm going to come at this from a long run-up. There was an interesting article on the BBC the weekend after the budget that had a couple of discussion points, and it said quietly radical budget. And I sort of agree with that, because there was a throwaway statement in the budget that the reducing national insurance might mean that they're going to lead it towards completely axing national insurance as one of the tax regimes that we have. National insurance has been about since 1911, so it's a very ingrained system of tax that we have. And if they're trying to get rid of it, there's a lot of fallout that will happen from that. National insurance is the mechanism that's used to work out if you're entitled to benefits, including the state pension. So if you get rid of national insurance, how do you assess whether people are entitled to the state pension? Also, if you're going to cut national insurance completely out of the system, it would have to have a corresponding increase in income tax. And that would mean that pensioners who don't pay national insurance suddenly have an increased tax rate. So all of this says to me, and this is opinion, not fact, I can't see that any political party, no matter who's in power, who will have the guts and drive to push that change through, considering how disruptive it is. So I'm not convinced that actually national insurance will be axed anytime soon, but I could be wrong. The other thing that it talks about here, and I've not number checked it, but in general I sort of agree with the principle here, is to say that for every £1 in national insurance cut, actually there's still a £1.90 tax increase affecting the average person. Mostly due to fiscal drag, so being where all of the tax rates have been frozen for so long, and inflation being as high as it is, it's driving in more tax take. So it's giving a little but still taking 2 steps forward and 1 step back sort of thing. So let's go through the headlines for that came out of the budget. Class 1 national insurance, the national insurance paid by employees have been cut to 8%, having only just been cut down by 2% from January. The interesting thing about this tax rate is it's coming in from April. Now I think the intention is to make employees feel like they've had a bit of pay increase because they've got a bit more post-tax money in their pocket. But most small businesses, in fact every small business I speak to, are having to put wages up in April because of the increase in the national living wage being a quite sizable jump. Is creating a domino effect in most people's staff base where they've got the employees at the bottom are on minimum wage. Pushing them up means they then need to push up all the next ones to make sure that there's parity between all the levels of staff. So how much will employees put down their increase in money to a cut in national insurance, and how much will they put down to their pay rise? This then leads on to Class 4 national insurance. That's the national insurance paid by self-employed people. And I'm going to discuss this in a bit more length as we go through. But what was interesting in the autumn statement, they said they were going to cut it by 1%. So employees had a 2% cut, self-employed had a 1% cut, and then they've cut it further. So it's now going down to 6% from next month. So it will apply on next year's tax bills. And a surprise cut, one that wasn't foreseen, I don't think, by most people, was that they've cut the top band of capital gains tax on property sales for buy-to-let properties, essentially, from 28% to 24%. This, and a bit of opinion on this, is that this sort of feels like an encouragement for the buy-to-let landlords to put more property onto the market, giving a little bit of a tax break. So, all right, actually the tax rate's a bit lower, I'll divest some of my property portfolio whilst it's lower. We don't know how long this tax rate will last. But what also is interesting is they didn't cut this tax rate all the way down to 20%, which is the capital gains tax rate you'd pay on any other asset. Theory being, if they went down to 20%, do they have some projections that suggest too much property will flow onto the market and result in property prices coming down rather than up? There is a tale I've heard, I don't know how true it is, that the Conservative Party tends to be re-elected as house prices are rising. So whether this feeds into that myth or not, we'll see what happens over the coming months. Then the final thing, which I think only affects a smaller number of businesses, but I think it's important to note, is that the VAT threshold has been increased to £90,000 from the 1st of April. This has been frozen since 2015, so this is quite a big change for the government, because in 2015 they said they were freezing it, because essentially the intention was they wanted every business to be VAT registered. So they almost wanted to get this down to zero. So the fact that this has increased, although it's not a very big increase, because if you were to keep the VAT threshold going up with inflation, it should be about £105,000 now. But it does show a change in policy, that actually they are releasing the pressure in the VAT system for very small businesses, where the VAT threshold is artificially keeping some businesses back in being able to generate higher profits, and it's a very painful ceiling to crack through. A number of clients we have had to crack through that ceiling, and I hope that for many of them, by cracking through the ceiling, they've now unlocked some more potential in their business. For others, they're now looking at the deregistration limit of 88,000 and thinking, actually, we're still under this new deregistration limit and looking to go back to the before VAT times. So it's an interesting thing, but as I say, it affects the smaller end of the market. And then the final thing, which I'm going to restrain myself because I do have a tendency to rant on this subject, the child benefit higher income tax charge, they suddenly decided that, oh, actually this is really unfair because single earning households are penalised against households with equal earnings. Causes massive problems in parents who are separated, where you have a divorcee and you get a divorcee having to pay a child benefit charge. It's just an absolute pain, and they've identified it, but rather than scrapping it, they've just increased the point at which the charge starts to be collected to £60,000. I have heard reports that this tax costs as much to administer as it does that it collects, so that's why a lot of people are pushing for it to be axed. I haven't fact-checked whether that's true, but I'm just spreading rumour. So let's look at some numbers now. So the Class 1 national insurance, where Class 1 national insurance applies in certain bandwidths, this only really applies between 12,500 and 37,000. So it's only got a limited bandwidth in which you can save. So the maximum tax an employee will save is 1,500, which, okay, most employees in that bandwidth aren't going to sniff at that, and even if you're a higher earner, you still get a 1,500 a year tax cut. For the self-employed, it's slightly lower because it had a lower base to start from, so it's a 1,125,000 tax cut that's just been announced for self-employed. To give a little bit of an example for how the capital gains tax cut can affect individuals, if you've got a property, let's say you had a property, you bought it for 250,000 and you're now selling it for 300,000, so you've made a 50,000 gain. That's the sort of tax saving that percentage will make, which isn't insignificant, but I have had a client point out to me to say, well, it doesn't really matter because the estate agent fees are higher than that. So that's the bandwidth they're putting it against. So in which case, it's a little bit of encouragement, but it's not going to be any great shakes by the sounds of things. So I always look at the budget and say who are the winners and who are the losers, and it's almost like the tax system is a load of dials, and they'll turn some structures up and some structures down. So let's look at what's happening here. Employment, definitely there's a boost for employment because the tax rates that an employee now pays are down. The self-employment definitely also have had a boost because the tax rate has been dropped effectively by 3% on that middle band between this time last year. Property investors are probably lukewarm, I'd say, because although they've got this tax cut if they want to divest their property, really what the property owners want, they want to get the mortgage interest they suffer on their buy-to-let to be fully allowable against their taxable income. And that still remains restricted to a 20% benefit of that cost. So really, property investors, I think, remain lukewarm. And then pensioners are probably a bit miffed because they've not had a tax cut, and they've seen a tax cut fly past them that specifically targets employment and doesn't touch their income at all, although you could argue about a triple lot for state pension and things like that. And then finally, you've got limited company businesses, which are probably bloody annoyed. Because having gone through the last 4 years of keeping your business afloat through COVID, having it that company directors who tend to have a small salary and not really supported by the furlough scheme, then only 3 years ago, the microphone's gone off, is it? You still hear me at the back? Great, that's right then. So only 3 years ago, Rishi Sunak tried to increase national insurance and increase dividends tax rates. And when that happened, then Kwasi Kwarteng came along, tried to cut the rates, and then the current Chancellor stood back in, and when he came back, he reduced the national insurance increase, but did not stop the rise in dividends tax. So limited company owners are paying higher corporation tax and higher dividends tax than ever before. So for limited companies, if we look at the rates that a limited company pay, these are the tax bands on corporation tax, 19% up to £50,000, and then a horrible rate of 26,500 as it tapers up to the full 25% band. But effectively, if you want to work out your effective rate of tax, you'd use these bands. And then we'll look at the effective rates of tax on dividends, and these are 0% up to 13,000 if you haven't used up your full personal allowance. You've then got up to 50,000 at 8.75%, a higher rate band at 33.75%, and then you hit this horrible band of just over 50% as you start to lose the personal allowance off the top. And then, weirdly, the tax rate then drops to just under 40%. So these rates are what you need to use to compare to make sure you're assessing what your tax rate is from a limited company. So assuming you draw every bit of money out of your limited company, the worst tax rate you might see is a horrible 63.71. And anyone who was here last year will have seen that number before. But that hasn't changed. But what has changed is that self-employment has now had a tax cut. So actually, there's a disparity between the two. So I often get the question, what's better, a limited company or a partnership? Well, the worst possible tax rate for a partnership or self-employed business is now 62%. But that's still the top rate. So this time last year, I did a calculation, and I said at £84,000, a limited company reaches the top of where it saves tax if you're drawing every bit of profit out. So now, if we look at the tax rates, now you've got the national insurance cut in there, and say, if you had £84,000 of profit in a limited company business compared to a self-employed business, what does that now say for the tax saving? And actually, a partnership or self-employed business is now saving £1,300 of tax compared to a limited company. So self-employment is now more tax efficient than a limited company, which is quite striking at £84,000. It's not a huge profit figure for a business. So at what point does a limited company stop being tax efficient compared to self-employment? Zero. Apart from a couple of tiny little blips and quirks in the tax system, if you're drawing every bit of profit out of your business, a self-employed business will now be more tax efficient. which is a very striking thing to be faced with in the tax system. Now, I do apologise, there's a graph here, and at the back it's just going to be a couple of blurred lines. But just to walk you through what this graph is doing. So this graph shows you the net income you would get from 3 types of structure. The black line at the top, which just sort of evenly goes up, roughly, that is your net income from a self-employed business as profits increase along the axis at the bottom. So you can see that that remains the highest way of getting net income out of the business if you're drawing every penny out of that business. The red line, which starts trying to keep up with the black line and then starts to tail off, that is if you draw everything out of a limited company through a small salary and dividends. You can see that it just about holds its own, but not quite at the initial stages. And then once you get to about £110,000, it starts to tail off and come down towards the blue line. Now the blue line is, I've put that in there because another question that I often get is, should I be taking all of my income from my company via a salary? And this blue line is the reason why I say generally that's not going to be the best structure to use. Because in terms of net income, because the personal tax rates are that much higher for a salaried income, it means your net income will be less than it would be through salary and dividends. So that's where this blue line is. You can see once you get into the higher ends, you've got £305,000 of profit that you're trying to take it all as a salary. There's not a lot of difference there, but you're getting into territory where you really need tailored advice there. But I hope that this helps pin some of these ideas on, because the calculations underlying it are a little bit too complicated. So I just thought this is the easiest way of showing what I'm talking about. So tax structures, should I take all my income as a salary? I'd say probably not. There is a little bit aspect that you can save more corporation tax by doing that, but then the money's trapped in the company, and if your intention is to draw everything out of the company you can, then by taking that bit of saving that you've got, you're then going to end up paying more tax anyway, so it won't work out efficient for you. Should you convert your business to a self-employed or partnership business? I'd say probably not. And the reason I say that is because if you're a self-employed business, you haven't got the legal protection of a limited company structure. And that means although you have insurances, so if a customer were to sue you or things like that, you've got insurance to protect you. There's no legal protection between your personal assets and that of the business. And you end up in some tricky situations if you were to fall through the net of insurance. The other thing that I would also say is if you've got employees, particularly long-term employees, then you have got personal liability to those employees. So if you found that the business needed to shut, you needed to make redundancies, you haven't got any protection against the costs of those redundancies, and you could effectively have to sell your house to pay for you making staff redundant, compared to a limited company where you've got protection from the legal structure. So this then leaves another question, which I say people ask me, it's usually a question that we ask for people, is should I have a limited liability partnership? And I'd say possibly. Because in many cases, a limited liability partnership gets you the best of both worlds. So let me just explain that a little bit. The positives of a limited liability partnership is that it has the legal structure of a limited company. It's legally separated from your personal assets because it is limited. So that's a big positive, but at the same time, for tax purposes, it's taxed, transparent for tax, meaning you're taxed as if you're self-employed. So all of the stuff we've just been looking at where self-employment has got tax benefits, the LLP gets you those without giving you the personal risk of your assets being at risk to the company. The other thing that often company directors end up saying, this is why I like LLPs, is because there's no benefit in kind on company cars. So the tax position of putting your car into the business, we do some tweaks in the accounts, but it means you haven't got to pay that benefit in kind tax charge. So it actually works out quite efficient in that way for many people. And the final thing to note is that the PR is quite good because it's still got the limited company status. So you've still got LLP at the end, so it holds it. Sorry, there's a question.
Yeah, just a quick one. Is that benefit in kind only on cars, or does it apply to other things like medical insurance?
Everything. For an owner of the business, everything. Because the technical basis of this is an owner of an LLP is a partner, they can't be employed by the business, so therefore they can't be taxed under employment law on those benefits. We'd have to identify it when we do the accounts, but you don't have any of those charges.
Can I ask you, are you making these slides available?
We will make our slides available. Patrick's slides will be kept under wraps, but these will be available.
Take photos of those ones then.
Yeah. Don't say that.
All the way out.
Do you want security?
No photographs. Okay, and then, but there are downsides to an LLP. They still publish their accounts at Companies House, and one thing to bear in mind here, which affects limited companies as well, is there is legislation now in place that is trying to push for small businesses, so those who have small company exemptions. It is possible that in the coming years, anyone who publishes accounts at Companies House will start having to publish their profit and loss, which I think is incredibly controversial for small businesses, where the business is of a size that you can't hide margins from your customers. There is currently, although the legislation is there, it doesn't have a date for when it's coming in, and it doesn't have details about exactly what's going to be published, but I just thought this is the point I need to make sure everyone is warned that this is a potential incoming towards us. The downside of an LLP is it has, because it publishes at Companies House, you've got a higher administrative cost, just like a limited company as well. And then probably the most important thing to note, which I've tried to sort of hint at as I've gone through, is all of this tax planning relies on not having retained earnings in your company. If you've got profits that you're leaving in the company, then a limited company still has the potential to save tax compared to an LLP or self-employment structure. There are ways around this, but generally this is the basis you've got. If you're retaining significant earnings in your company, an LLP might not be the right choice for you. And that's why I put possibly rather than yes. And then the final thing to note is if you currently have a limited company, it could be expensive transferring from limited to an LLP. So if you've got a new business, it's fairly easy to transfer. You just set up an LLP and start trading in that. If you've got an existing business that doesn't really have significant amounts of capital on the balance sheet or a capital value, so if it's basically you do the work and it doesn't really have a resale value, then it should be fairly simple to transfer. But if you do have significant value in your business, it's going to need a lot more complex planning to work out if it's going to be beneficial to move and how to structure that move, if so. So the final thing, this is my last graph, and I realise these are all very hard to read from the back. The red line at the bottom, this graph shows you tax savings now. So this is a limited company's tax savings compared to a self-employment. The red line is what we've been looking at, where a limited company versus a self-employed structure, and you're drawing every bit of profit out. So as you can see, the tax savings, as the profit goes up, just plummets off the bottom. Go back, not that long ago, 10 years, that would have gone the opposite way for a limited company, but now the limited company just plummets down if you're drawing every bit of money out. The blue line is, I've got the formula that I'm running in the background of this to say for every bit of profit over £65,000, in this example, the business retains 50% of all of the surplus and pays the owners the other 50% of the surplus. So it's retaining 50% of all profits above £65,000. And on this working, you only need to save about £6,500 for you to break even with a self-employed basis for tax savings. So what I'm trying to say here is, although I've just said limited companies should be really, really annoyed, there is still a good use case for limited companies. So if you have a limited company, don't despair, it might be the right structure still. So my final bit of advice to frame all of that is, I think the first steps are to know what you want to get out of your business, know what you need to draw out of it, know what you're trying to drive your business, because if you're able to develop business, build profits that you don't need to draw, and then your long-term aims of how you exit the business, that might all add up to say you're in the right place. So know your goals before you set your tax structure, and then you fit your structure to those goals. And I always say, don't let tax be the tail that wags the dog. It is important, it needs considering, but I think the business decisions have to come first, and then you fit the tax to that. So in a bit, Joe's going to talk to us about the actual structural stuff inside the business and making tweaks and actually, how you might get your profits to be beyond what you need to draw. But you're going to have a little break from us accountants in between. I'm going to invite Tim up to talk to us about the FSB's take on the budget. So, Tim.
I feel a bit intimidated following that. Thank you very much, Josh. That was a very enlightening presentation. What I'm going to talk about this morning for my 5-minute allocation is the context within which this budget was produced, what the Federation of Small Businesses asked for and what the survey said. Context is key to everything in this, and we poll our members every quarter in our Small Business Confidence Index. We ask them their fairly subjective business confidence and then metrics on revenue, employment, investment intentions and the like. And in the 3 years that I've been doing this, I have not seen 4 continuous quarters of decline in business confidence. And even though they massaged the figures to say we weren't technically in a recession, if you were to look through those findings, you'd see that we were in a recession. Small firms were employing fewer people, they were looking to grow a lot less, they were looking to put their money elsewhere. And we realised the context as well of a year of 10% inflation, of not historically high interest rates, but contemporary high interest rates, and 1 million people remortgaging in the last year. And we don't just have a business confidence crisis, we have a consumer confidence crisis. So there was a lot of expectations in this budget, being a pre-election budget, that there was going to be something to give away. And we saw stories, I don't know who leaked them, but there was a story that they were going to increase the 40% threshold to £75,000 to offset the fiscal drag that Josh mentioned. And that would have been a great boost to business confidence and consumer confidence, especially because people would have had more money to spend. But we didn't get that. But the Federation of Small Business asked for 3 top key things. First, to increase the VAT threshold to 100,000. Right, we didn't get that quite as much. We got 90,000, but it will make some difference to businesses that pay VAT, and a relief to those businesses that were approaching that threshold. To offset and make it easier to employ people, particularly in light of the minimum wage going up, we wanted to increase the employment allowance to 6,500. We got some of that last year where they increased the employment allowance to 5,000, but we didn't get much on that. And we wanted the recovery loan scheme to be extended, and the government extended it for 2 years. But there seems to be a lot of short-termism in what the government have been doing, particularly with lots of businesses with the business rate relief in retail hospitality. We didn't hear anything about that, and it was only extended for a year from the last autumn statement. So what did the survey say? Well, we held a focus group, and Emma White from A4G joined us, and I see some of the other members of the focus group are in the room. And one attendee, who will be nameless, put it like this. He said, "It was all well and good for the Chancellor to lower expectations, but it was disappointing that he met them." It doesn't seem to be that they wanted to jumpstart the economy, that they were opting for prudence instead of a dash for growth. And that's one of the problems we've got. Lots of our members looked at this budget and thought that it wasn't what they wanted. It wasn't going to increase business confidence, and it wasn't going to get more punters through their doors. So I'll leave it to you to decide whether this is going to really increase business confidence and consumer confidence. I've given you hopefully a welcome break from PowerPoint, but now I'll hand over to Joe.
Thanks, Tim. That was insightful. So for us, obviously, following on from what Josh said, Josh has talked to us about the impact of how sort of the tax impacts what we can do. We're going to look at what we can do to impact our net profit and what we can take home. So the first port of call is to understand what you're currently earning, what you need to earn, where you need to go from there. So in order to calculate our break even, the first step is to work on our desired income. How much do you need to live on? This is your essential costs, and included within this, we include our luxury costs as well. So we're in this to earn some money out of it. What do you need to suffice the lifestyle that you want? From there, we then need to know how much of this needs to come from your business, from this business. So if you've got any rental income or any significant interest, how much of that can come from elsewhere? How much needs to come from this business? From there, we then look at how much tax you're paying on that income and how much you'll net in your pocket to pay your bills. So, if we assume you need 65,000 in your pocket, that will mean you need £80,000 worth of dividends in order to meet your bills as they come due. We have £80,000 of dividends. Apologies at the back, hopefully the numbers are big enough. We've got £80,000 of dividends at the bottom here. What that means is we need £80,000 worth of net profit in order to pay those dividends out and have the retained earnings we need. From there, we can then look at the impact of tax. So we can calculate the tax that we're going to pay, work this backwards, to work out that we need to earn £107,000 to pay 27 in tax and see £80,000 of retained earnings to pay us our dividends. The next step from there is to look at our overheads. How much are you spending on office costs, rent, light, heat? How much are you spending on admin staff that you can't do without? Have you got any finance you need? Are you leveraged in any way? How do you go about financing your business? We add all of those together and we expect to get a relatively consistent cost month on month. This is what we would deem your overheads. In this case, we've assumed your overheads are £30,000 to run the business that you're currently running in its current state. That means we need a gross profit of £137,000 in order for the money to flow through, pay our tax, and end up with the £80,000 dividends we need to live on. We then look at our cost of sales and the margin we're making. The gross profit is sort of deemed the profit we're making after our variable costs and the costs we can directly attribute to ourselves. So this might be your chargeable staff, your goods for resale, your materials you're buying, anything that's directly attributable to your sales. By selling more, you're going to spend more. We can look at this as your margin. In this case, we've assumed a 35% margin on your sales, but we need to look at if that's what you were expecting. Is that what you're getting? Is this the margin you're currently getting? What are you currently earning? And do you have a range of contracts that are perhaps at different rates? So if you've got different rates, we need to take an average gross profit margin in order to work out our turnover. From here, we can work it all the way back to see that we need £390,000 in order to see our gross profit, our net profit after tax of £80,000. Now, when you work those numbers, we can see that whether we're working on a monthly basis or a daily basis, perhaps this is £32,500 a month or £1,500 a day. You can then look at those KPIs and understand where your business is. Are you above or are you below? What days are working, what days aren't working? Now, if you've got a surplus, then that's great. If your turnover is greater than that, then that's great. If you've got a surplus, you've got money to fall back on, you can leave those in the business. If you've got a shortfall, then you've got a number of options really. The first option is to reduce the bottom line, reduce your dividends and reduce your retained earnings. Hands up if you're willing to work as hard as you are working for less money. Yeah. So that's not really an option, let's be honest. So in that case, what we need to do is we need to increase our profit in order to see better dividends at the bottom. Now, there are 4 ways in which we can do this. The first 2 are slightly defensive. The first one being cut our overheads. So this is the most common that people see as the first option. They'll go out, we'll try and renegotiate our bank contracts, our phone contracts. If you're spending 2 hours trying to find the right bank to go to, then spending another 2 hours of actually negotiating with that bank, going through their money laundering checks, you're probably going to save yourself £10 a month. It's £120 a year, which is £27 an hour. People want more than that. So if we look at the numbers, if you can save 5% cut in your overheads, that means you'll save £1,500, which is a lot of work to save that 5%. Now the impact of that is that you see £1,215 after tax. It's a 1.4% return on saving that 5% cut in overheads. Our second option is to negotiate suppliers. So rather than negotiating our overheads, we negotiate our suppliers in our cost of sales, or we look to improve our efficiencies. Can you get more out of the staff you've got? Can you get lower discounts on the things you're buying, bulk discounts, early payments? What can you negotiate? Again, still difficult, still has to be managed to ensure you're not losing service. But if we can save 5% on our negotiating suppliers, that means we're seeing about £13,000 increase in our gross profit. Once we run that through the numbers, you're seeing about £9,500 on your bottom line. Now, as Josh mentioned, whether you draw that or leave that in the business is entirely up to you, but it's nice to have that additional reserves there to fall back on should costs start to increase or should they start to change. The next two options are more offensive than they are defensive. So the first two mean that we're going out, we're cutting where we can, we're trying to save where we can. These next two mean we're pushing the business forward, we're trying to grow. So the first option is that we find new business. This is normally at the same margin, we're buying at the same margin, the same gross profit rate. We're trying to get more business through the door. You might have to invest in business development, you might have to invest in a sales team, but the impact is that we can move a £390,000 turnover to 410 just by attracting 5% more business. What that means on your bottom line is that actually attracting 5% more business means you see £5,000 more on the bottom line. So when you're working that margin, it's slightly diminishing your return on the investment of that 5%. The final option is that we optimise our pricing. So rather than just looking at getting new business, perhaps we look to increase our prices to our existing customers. Everyone seems to be apprehensive about this because obviously no one wants to actively raise prices to their customers. So, but what it effectively means is actually you're looking at the value that you're giving them and the value of the service you're providing. So are you providing more over and above what your competitors are? Does your price reflect that? If you can increase your prices, you might find some fall away, those price conscious customers, but actually you'll retain a better margin on the ones you've currently got. You hopefully will see a better return for that work you've done. So if we were to optimise our pricing, we simply increased our prices by 5%. Virgin Media recently just increased their prices by 8.8%, so this is still not out of the realms of possibility for most businesses, and they consistently do it and they're still growing. So having that increase in prices is not necessarily a bad thing. But what that means for your business is you see nearly £20,000 more on our gross profit line. We've increased our margin from 35% to 38%. Once that filters through, if you can maintain overheads, given the increase in turnover, you see almost £15,000 return on that investment, which is about 18%. So there's a significant benefit for being a bit bold. Now, to summarise all of those options, if we cut our overheads, saving 5% gives you 1.4%. Negotiating 5% on suppliers gives you 11.9% more profit. Turning over by 5% gives you 6.4%. And optimising your pricing by increasing pricing by 5% gives you 18% more profit. So these are your options really. But actually you don't have to do one of them, all of them, in order, out of order. You can work on whichever one is best for you and your business. Everyone's return on investment will be different through each of these different steps. So you could look to increase your pricing whilst negotiating with your suppliers and cutting your overheads. There's no set way of working your business, of getting the right answers. It's about what works for you and your business. If you've got chargeable members of staff, negotiating with your suppliers is going to be a lot more difficult. Asking which ones are willing to take a pay cut will be hard. But actually, working on your gross profit has a better return on your money than what actually simply just pushing new business or just working on overheads. So we're sort of going into a low inflation economy, and prices are still going up. National living wage has gone up by 10%. As I said, Virgin Media has gone up by 8.8%. So people's prices are still going up, and there will be a ripple effect, a domino effect of what happens to those prices, and your prices are likely still to come and increase. But actually there's still money to be made, and there's still profit to be made by being the brave and looking at your prices and optimising your prices yourselves.